Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually think. Today we're exploring an expert advisor called Mahalanobis Flow Breakout. It's built around a two-dimensional statistical outlier detector that watches price returns and tick volume together, and then waits for a breakout to confirm the move before it acts. By the end of this video, you'll understand the indicator behind it, the exact entry and exit rules, the code that runs it, and a clear candle-by-candle example. Remember, this is educational information only and not financial advice. Let's dive in. So what does this expert advisor actually do? Most jump or surge strategies test a big return and a big volume separately and act when each one looks extreme on its own. The trouble is that price and tick volume are correlated, so what looks large on each axis alone is often just ordinary co-movement. Mahalanobis Flow Breakout takes a different route. It measures how abnormal a single bar is in the two-dimensional space of return and volume at the same time, using a statistic called the Mahalanobis distance. That distance folds in the full covariance of the recent market, the variance of returns, the variance of volume, and the correlation between them. A bar only qualifies when its combined return and volume coordinate is a genuine statistical outlier compared with how that market has been behaving lately. The squared distance follows, approximately, a chi-square distribution with 2 degrees of freedom, which is why the default threshold sits near 9, roughly a joint 3 sigma event. Importantly, the strategy does not trade the outlier bar itself, because its edge may already be spent. That bar only arms a direction. Entry then requires breakout confirmation on the very next closed bar, so the strategy is looking for the information move being accepted rather than faded. Stops are volatility-adaptive, based on the average true range, and the target is set as a reward-to-risk multiple of that stop distance. The natural home for this approach is liquid instruments, major currency pairs, metals, or indices such as Eurist, gold, or an index like US 500, on time frames from 5 minutes up to 1 hour, where tick volume is a reasonable proxy for order flow. This suits a trader who is curious about statistical, event-driven breakout logic rather than continuous signals. As always, trading involves risk, and losses do occur. This is educational framing only, never a promise of returns. Let's walk through the logic step by step. On every newly closed bar, the strategy builds a small feature vector with 2 numbers. The first is the log return, the natural log of the close divided by the previous close, which captures both the direction and the size of the move. The second is the log of 1 plus tick volume, which stands in for participation and activity. Over the last StatPeriod bars, which defaults to 60, the expert advisor computes the average of each feature and the 2x2 covariance matrix. That matrix holds the variance of returns, the variance of volume, and the correlation term that links them. Then, for the candidate bar, the one that closed just before the confirmation bar, it calculates the squared-Mahalanobis distance, written as d squared. This single number tells us how far that bar's joint coordinate sits from the recent center, while properly accounting for the correlation between price and volume. Because that squared distance behaves like a chi-square with 2 degrees of freedom, a threshold near 9 isolates rare, information-rich bars. The strategy then applies 2 extra filters. First, volume must be elevated, meaning the volume feature is above its recent average, so the focus stays on active conviction bars rather than thin, low-volume spikes. Second, the candle must have closed strongly toward its own extreme, at least the close-push PCT portion of its range, 60% by default, which marks a real thrust rather than a two-sided, indecisive bar. When all of that lines up, the anomaly bar arms a direction, but it is not traded yet. Entry needs breakout confirmation on the very next closed bar. For a long, the anomaly must be bullish, a positive return, a close above the open, and a strong push toward its high. And then the next bar must close above the anomaly bar's high. For a short, it's the mirror image, a bearish anomaly, and the next bar closing below the anomaly bar's low. Risk management is rule-based. The stop distance equals ATR stop multiple times the average true range over ATR period, so it adapts to current volatility. The take profit is placed at reward risk times that stop distance, a default of 1.8 to 1. Only one position per magic number is allowed at a time, a spread filter skips unusually wide conditions, and the stop and target manage every exit. Let's read through the core of the MetaTrader code as it appears in the editor. At the top are the input parameters you can adjust. StatPeriod sets the 60-bar window used to learn the return in volume regime. MahalThreshold is the squared distance cutoff, defaulting to 9. Close push PCT demands the outlier candle close at least 60% of the way toward its extreme. AtrPeriod and AtrStopMult define the volatility-based stop, and RewardRisk sets the target as a multiple of that stop distance. Max spread points and lots and magic handle spread filtering, order size, and position tagging. Now look at the long block. The Boolean bull anomaly is true when the anomaly bar's return is positive, its close is above its open, and its close sits far enough toward its high to pass the push filter. The final line is the confirmation. The trigger bar's close, T-close, must be above the anomaly bar's high. When all of that holds, the entry is taken at the ask, the stop loss is placed one stop distance below entry, the take profit is placed at the reward to risk multiple above entry, and trade.by sends the order. The short block is the exact mirror. The bear anomaly Boolean checks a negative return, a close below the open, a strong push toward the low, and then the trigger bars close below the anomaly bar's low. There, the entry is at the bid, the stop loss sits above entry, and the take profit sits below by the reward to risk multiple, sent with trade.sell. Clean, symmetric, and fully rule-based on both sides. Let's bring this to life on the chart. On top you can see the candles, and in the panel below is the squared-Mahalanobis distance, our d-squared statistic, with a dashed threshold line drawn at the value 9. Whenever the gold line climbs into the blue anomaly zone above 9, the strategy has spotted a rare joint outlier in return and volume. Watch the opening candles. The first 5 bars drift sideways in a quiet, balanced range. The d-squared reading stays low, down near 2 or 3, telling us these bars are ordinary co-movement. Nothing statistically unusual is happening, so the strategy simply waits and keeps learning the regime. Now look at the 6th candle. Price surges upward on a strong bullish bar that closes right near its high, and it does so on elevated volume. In the panel below, d-squared spikes up to about 13, well into the anomaly zone above the threshold of 9. This bar is bullish, it closed far toward its high, and its volume is elevated, so it passes every filter. But notice the strategy does not enter here. This anomaly bar only arms a long direction. It now needs the next bar to accept the move. On the following candle, price presses higher and closes above the anomaly bar's high. That is our breakout confirmation, and the buy entry marker appears. The stop-loss marker sits below, one average true range-based stop distance under the entry, and the take-profit target is set at 1.8 times that distance. From there, follow the next few candles as buyers stay in control. Price grinds steadily higher, bar after bar, until it reaches the take-profit marker several candles later, where the long position closes at its target. Notice that all through that advance, d-squared has fallen back to normal. The information event has been digested. Now the market shifts. After the run higher, a candle turns sharply lower on strong participation, closing right down near its low. In the panel, d-squared jumps again, this time to about 14, back into the anomaly zone. This bearish outlier closed hard toward its low with elevated volume, so it passes the filters and arms a short direction. Again, no immediate entry. The strategy waits for the next bar to confirm. On the following candle, price closes below the anomaly bar's low, and the sell entry marker appears. This time the stop loss sits above the entry, and the take profit sits below by that same reward to risk multiple. From there, the last 2 candles push lower, selling pressure follows through, and price reaches the short take profit target. That's the full picture. A quiet regime, a genuine 2-dimensional outlier, a breakout that confirms the move rather than fading it, and a volatility-adaptive stop and target managing the exit. The same logic works symmetrically on both the long and the short side. Of course, not every signal reaches its target. Sometimes price turns and the stop is hit instead, which is exactly why the fixed stop and the reward to risk framing matter. So there we have it, the Mahalanobis Flow Breakout Expert Advisor. We covered how it measures return and volume together as a single two-dimensional outlier using the Mahalanobis distance, how the squared distance and its threshold near 9 isolate rare, information-rich bars, and how the strategy waits for next bar breakout confirmation before entering. We walked through the volatility-adaptive stop, the reward-to-risk target, the actual MetaTrader code on both the long and short side, and a full candle-by-candle example. If you found this breakdown helpful, please give the video a like, subscribe for more MT5 strategy analyses, and leave a comment telling me which strategy you'd like me to examine next. You can find more educational material over at www.algobot.live. Everything here is for educational purposes only and is not financial advice, and trading always carries the risk of loss. Past performance does not guarantee future results. Trade responsibly.